Of course, we know that markets gained on Friday. We saw a little bit of positivity coming through in today's session. Yesterday, we saw the markets close for a public holiday. But apart from that, we know that the markets have been taking a bit of a knock over the last few weeks.
Thank you for having me, Eleni. We observed today that the market gained marginally to close higher on the day. However, we also observed that there was about an 8% increase in volume of trades, whilst the value of transactions declined by about 27%. What this suggests to us is that there's an underlying weakness in market fundamentals, whilst the decline in value of trades also suggests a negative sentiment on the part of investors towards the market. To take this back to trading in the previous week, you observe that the market traded closed lower for the better part of the week, only to rally on Thursday, which was sustained on Friday. However, if you look closely at the transactions on Friday also, you'll notice that the value of trades declined by about 30%, while volumes declined by about 47% on the day. And this goes back to the negative sentiments we believe still continue to prevail in the market, and the fact that fundamentals still remain weak. Now, going back to April 2010, the outset of April 2010, when the market started its rally in the quarter, you observe that we currently have about 28,000 resistance level on the market and a support of about 25,000. And what that means effectively is that you will note that the market has failed to fall below 25,000 level in the last 2 months. That's April and May, and also has not exceeded to 28,000 level in the last 2 months. This level of volatility is expected in view of the, especially in the nature of results coming out of the banking sector, and the uncertainties involving the 8 banks that were involved in the CBN bailout plan. And we say this because the banking sector at present constitutes about 45 to 50% of the equity all-share index and equity market capitalization. And so, as long as these uncertainties regarding the sector remains, the volatilities in that sector will continue to affect the broad market. And we can see this in the year-to-date performance of the banking sector, which has declined by about 38% on the market relative to the manufacturing and all allied sectors that has gained close to 45% year-to-date.
Well, Adetola, you mentioned quite a few pertinent things there, and I'd like to take it back to the fact that you said that we are starting to see resistance levels at around 25,000, and the market's battle to push through that key 28,000. And when we did see those levels being hit, many were questioning what was going to push the bourse higher from these levels. You also mentioned that the banking sector is one of the key players to the negative sentiment that we do start seeing seeping through into the markets. Do you think that once we get clarity with the banking regulations, the reforms, the results, of course, all the changes that are occurring in the banking sector, and the fact that a lot of banks need to start recapitalizing themselves, do you think that is going to be the key element to see the NSE all-share rising higher from the 28,000 level?
That, amongst other factors, would contribute to the all-share index breaking the 28,000 level. However, we must state here that we believe that the recent decline we've seen in the last 2 weeks may not be unconnected with what's happening in Europe. Precisely, if you notice that the market picked up mid-March 2010, the knowledge is that we actually have a lot of foreign offshore fund managers with the appropriate risk appetite for the Nigerian market coming into the market with significant volumes, which drove the market since March 2010. Going by what's happening in Europe now, we believe these orders have dried up for Nigerian equities coming from offshore fund managers in Europe, and this may not be unconnected with the kind of decline we've seen in the last 2 weeks. We equally expect that if we can attain some level of clarity regarding the fate of the 8 banks that were involved in the central bank's bailout plans, we will also see a lot of rally in the market. We, however, must state here also that if you look at the fundamentals of the market, the banking sector at present currently trades at about 23 times its earnings, which is P/E ratio of about 23 times, whilst the broad market actually is trading at about 16 times its earnings value. So what we're saying here essentially is that banks that were involved in some of these bailout plans, and even the healthy banks, continue to give out healthy bonus payouts to their shareholders, which diluted earnings significantly. And so we now saw, as a result of that, where valuations got stretched further, where you now had banks trading at about 20 times current earnings and 19 times current earnings.
Well,
These were the levels,
also just looking, I mean, you know, looking at one of the other very pertinent issues, sorry to interject there, looking at corporate bonds and, of course, the market for corporate bonds, we know that there's great appetite, but we also know that the regulatory environment is not really conducive. What kind of changes would you like to see for companies, of course, and for the fact that they should be allowed to issue corporate bonds far easier than what we're seeing right now?
Well, for the listed companies in Nigeria right now, the issuance of corporate bonds is fairly easy. However, what the challenges lie in the fact that the pension funds investments in pension assets, as they are currently constituted, need to undergo a lot of amendments. And besides the listed companies, private companies need to also access the corporate side of the bond market. And we have actually recommended that we need to have revised guidelines regarding how corporates and pension fund assets can be invested in corporate bonds.
Adetola,